Good afternoon. It's Mark Santero with Homestead Advisors. It's March 28th, almost the end of the first quarter 2023. My, how the time has flown by. And want to welcome everyone to our second installment of our webinar series. As you know, each month or each webinar, we turn to a different topic. And this one, I think, hopefully resonates with everyone. It's certainly on a lot of people's minds, and that's tuning into employees' financial wellness concerns and how homestead advisors and homestead funds can help. So, what is the format today? It's similar to every format. After the capital markets update, which I'll go over, we'll introduce our guest speakers who will cover three different topics today. All attendees are on mute, so your questions, if you have any throughout the webinar, there is a Q&A box. Type in your question there in that feature. As always, this meeting is being recorded. You'll get the recording via email next week. And for those that want CEU credits, proof of attendance will be provided in the post-event email. So let's get started. That is me. Let's go to next. I'm going to cover the market review and outlook, and I'm really not going to spend too much time here. We did have a little bit of a rebound in the fourth quarter of 22, but overall equities were down, bonds were down, and it was the second year in a row that bonds were down, something that we hadn't seen in the markets in over 40 years. So I'd rather not spend any more time on 22 and go to the next slide and talk about US inflation. As I mentioned, we peaked at our high rate of inflation in July of last year at about 9%, and where we are today, and as at the end of February, at around 6%. If we look at the drivers of inflation, energy has come off considerably from where we were in 22. Food has come down and dragging down the overall inflation index. And now we're in a market term, the sticky part about where we go from the 6%, 5.9% range where we're currently at down to the Fed's target at 2%. We think it's more realistic to be at around 3%. And what are the drivers of inflation? They continue to be labor concerns. And it's a theme that we're going to talk about throughout these slides going forward. So prices for goods and service look to be trending lower, but inflation is really tied to that labor market. And the Federal Reserve trying to get a handle on that is going to be somewhat challenging. But if we can go to the next slide. Labor concerns persist. This is something that, even though we're starting to see companies announce layoffs, companies downsizing, it's still the sticky part of inflation, and it's labor in certain sectors of the economy more specifically than it is overall. We've seen technology companies, we've seen finance, banking, insurance companies do layoffs, more of a downsizing because of their ramp up in labor post-pandemic. But the service industry, the hospitality industry are still experiencing labor concerns, and those are being passed on to the consumer, which again is how we have the inflationary pressures we're seeing right now. So when we look at that spike in the unemployment rate post-pandemic and how significantly it's dropped off, we're at some lows in 22 that we haven't seen in over 20 years. So labor concerns persist. If we can go to the next slide. And this is something, I know it's a busy slide, but this is not a familiar playbook for the Federal Reserve. Where we see high Fed funds rate, which is the dark green line that's spiked up since the Fed started hiking interest rates, and the core personal consumption expenditure rate basically on top of one another. If you look at the recessionary times that we experienced in the 2000s and then the financial crisis in '08 through '09, that was, if you look what happened right before that spike in Fed funds rate, the CP CPE number was still relatively flat. Where we are today is something that the Federal Reserve hasn't experienced. So this is a new dynamic in interest rates and the increase in federal overnight rates and how that's affecting inflation. That spike in the CPE, even with the Fed tightening, it's come off a little bit, but we're still high. So it's something that is in uncharted territory, so to speak. We can go to the next slide. So what's been driving the market has been inflation. It's something that every announcement, every market prognosticator about will we have another rate hike, how much is it going to be, what is the Fed telegraphing, has affected the equity markets from its overall performance. Not since 1926, we've only seen 12 times, including 22, where we've seen double-digit negative returns on the S&P 500. So inflation worries continue to sink stocks. Now, what does that mean going forward? Every time we have an announcement, every time, and we'll talk about the banking crisis, how that affects the Federal Reserve, it affects the equity markets. But one thing it will affect going forward is the higher cost of capital. The Fed funds rate and the cost of borrowing is going to affect corporate earnings, which could lead to recessions, and it's not a great outlook for stocks relative to past market cycles over the last decade or so. So if we go into the next slide, so here the big question, are we heading into a recession? There are a couple of things that typically have to happen, not necessarily all at once, but when you have all these 1, 2, 3, 4, 5 warning signs, it typically will bring us into whether it's a mild, not too deep, not too long, or severe, deep and long recession. Right now, 4 of the 5 warning signs have been hit. Inverted yield curve. We've seen the 10-year yields below the 2-year since July of 22. Unemployment, I'm going to come to last. Consumer confidence has been negative since September of 21. And consumers, as we hopefully all know, are the key drivers of our economy. And when consumers' confidence levels are down, typically it means they're not spending as much money and they're saving, and it's a drag on growth. Housing starts have come down in 22. Why? Well, mortgage rates are higher and the cost of owning a home due to the borrowing costs have slowed it down. And we had some supply chain issues, but mostly that's down from their peak, 22% off their peak because housing starts have slowed down. And then the leading economic index, it's down 4.2% from June through December. And in the previous 6 months, it's declined 1.9%. The only warning sign that hasn't been hit yet is the unemployment rate, which I talked about. Labor is still the driver of inflation, and it's not necessarily slowing down. Can we go to the next slide, please? So, how have stocks historically rewarded patient investors over time? I want to focus on, it's a little bit of a transition here, but if you look at from 1983 through 1998, we had two issues in there. We had the black in the 87 crash and we had the tech bubble burst in those time horizons. But 83 through 98 were what a lot of market participants and economists are talking about. Could we be entering that market because of the Fed funds rate going up and the Federal Reserve acting the way they are, which is very similar to Chairman Volcker taking us out of the 70s and into the early 80s where inflation was spiking. And we saw, once we got through the market crash, we saw relatively nice, with a couple of bumps along the way, rise in the S&P 500s. So I think we're going into that type of market, but we haven't had not a crash, but a greater than 50% recession outlook based upon a survey of leading economists. So what that means is although we may be in for some choppiness down the road, historically, this chart tells you patience can be rewarded. So let's go to the next slide. I didn't want to end the market outlook without talking about what's happened in the last literally 2 weeks, which is what happened with SVB, Silicon Valley Bank, Signature Bank, where because of specifics at these banks that were specialty lenders that basically went under. And then you had Credit Suisse as well that had to get bailed out by the Swiss government as well as get merged or get bought by UBS. Credit Suisse, Silicon Valley, Signature, very unique situations of those institutions. And rather than go into each and every one of them, what investors should keep in mind is these were very specific institutional problems. Now, Credit Suisse has had issues for many years. Um, the government wouldn't allow a Credit Suisse UBS merger because of just the size and enormity of that giant institution. Well, it's a reality now. Silicon Valley Bank was a specialty lender and got into an interest rate problem with their depositors. So the important thing to know is regulators have stepped in. If you have your money at a bank, you're insured up to $250,000 through FDIC insurance. There was a concern about regional and small banks because they changed the Dodd-Frank banking laws in 19 that it used to be 250 billion, 50 billion with capital reserves, and they raised it 250 billion. So it kind of took away some of the safeguards in place. The good news is it's slowed down. I think investors' fears have been alleviated, and we're seeing those stock prices rebound. We're seeing depositors stay put. But what it has done is one of the things that we think is going to be important going forward is the tightening of credit is going to, whether it's small banks, regional banks, or even perhaps the larger banks, the availability of credit is going to get a little tighter. And in essence, with the tightening of a credit because of some of the issues that we've experienced, means that could be anywhere from, depending upon who you listen to, a 25 to 50 basis point, one or two additional rate hikes baked in just by the banks, where the Federal Reserve doesn't have to do that. So in essence, the banks could be doing some of the future tightening for the Fed just by tightening their credit. So if we go to the next slide. There are some bright spots. I know I sound doom and gloom, but if we look at this chart with the tightening and where we were in just in 2020 with the height of the pandemic and where rates are today, there is income back in fixed income. And if you look at the credit spreads from January of this year to where 2-year treasury yield versus investment grade, they've widened, and that's investment grade bonds. We see typically spreads are investment grade on top of treasury. So the outlook for fixed income as the Fed hopefully starts to slow in its tightening cycle, we'll see getting rewarded for credit, taking credit risk with investment grade bonds. Income should be a better play than what it was certainly in 21 and 22 from a yield standpoint. Next slide, please. So economic outlook, choppy markets will continue. We've already experienced that. Fed rate hikes in 23. We've just had one. How many more? I'm going to give 3 scenarios. Right now, the markets are pricing one in May. So one more. And then from there, there's 2 viewpoints, whether that's a pause or whether inflation continues to rear its ugly head and we may have another one. Right now, it's perhaps 1 to 2 more, but we think it's one and then a pause. And the probability of a mild recession, we still feel that may be the case. Taking in consensus views, it won't be deep, it won't be long, and then we'll see a gradual rebound in the economy. The nominal rate right now is for Fed funds is at about 5.1 in 2024. That rate comes off to about 4.3, 4.5, which means that in 24 we might see the Fed starting to ease to come out of that recession. Stocks with earning multiples propped up by free capital, you're going to start to see earnings come down, but still somewhat for quality companies, we expect to see them, come off a little bit, but do well going forward. And on the fixed income side, as I mentioned, income is back. So how does this all affect co-ops? The last slide for me. How to deal with market uncertainty and volatility. We're here to help. And you're going to hear from three of my colleagues talk about what Homestead Advisors does. But if you have assets at your co-op, whether they're corporate assets, whether they're community purpose accounts, whether they're health benefit accounts, etc. And with these changing markets and the future markets going forward, talk to us and help us and allow us to help you assess your assets and how you should be positioned going forward. So dealing with market uncertainty means speaking to a trusted advisor, and hopefully we're that for your co-op. Environmental uncertainties, unfortunately, we continue to have them in our country at a rapid pace. It used to be planning for hurricanes. Now it's fires, it's wind, it's rain. We work with co-ops in helping set up a storm reserve account for those uncertain times. So again, talk to us. And then really the two things, we talked a lot about labor. We have a couple of programs that you can use to help attract, retain, and reward your employees. One is deferred compensation plans. They're a benefit that if you haven't dusted off, talk to us about maybe adding additional employees. You may have new employees on the payroll that may qualify. There could be some retention tools, some rewarding tools to bring your people in the fold to retain them. And then certainly the last one is employee sponsored savings program. That's a program where you can, not a benefit, but it's a savings program where you can help do a match program for your employees. But these issues right now are really driven by the economy, uncertainty in the market, environmental issues, and labor concerns. We have programs that we've worked with co-ops to help them address these issues. And you're going to hear more about this with my colleagues. And so I'm going to take a breath. If we can go to the next slide. Our first speaker is Brian Allen. Brian, you probably all know, he's been around for Brian, over 20 years now.
21 now.
That would be over 20 is 21. I'm going to have Brian talk to you about some of the programs we offer co-op management, and Brian, take it away.
All right. Thank you, Mark. Over the past couple years, I've had many conversations with cooperative leadership and employees about financial health and preparedness. And it's been during those conversations that I have discovered how few individuals are at an appropriate savings level in their personal finances. Individuals are overwhelmed with their budgets and they're searching for any solution that they can find to stay ahead. In my part of the webinar today, we're going to explore how you, the cooperative, can be a solution in helping employees improve their financial health with a focus on personal savings. Next slide, please. With today's inflationary environment, everyday Americans are struggling with savings. According to the Federal Reserve Report of Economic Well-Being of U.S. Households from a couple years ago, 36% of Americans didn't have $400 in an emergency savings account to pay for an unexpected need, like a car repair or a home repair or an unexpected medical need. The fact is that Americans are struggling with the lack of savings, and when you couple that with the current inflationary environment, it has made it very stressful and difficult to pay off those monthly fixed bills and just to financially get by. Next slide, please. However, $400 in savings is not enough to be fully financially prepared. It's just a stepping stone. A fully funded emergency savings account ranges anywhere from 3 to 6 months worth of living expenses or salary. 3 to 6 months of savings helps to cover long-term disruptions like a loss of job in the family or long-term leave because of an injury, and even larger expenses like the needing to replace a car. Next slide, please. So in my conversations with our cooperative employees, the best way to fund emergency savings accounts is to pay yourself first. Individuals that use techniques like payroll deduction or systematic bank purchases to fund emergency savings accounts are much more successful savers than individuals that just use leftover monthly expense surplus to add to their savings. As one employee once put it to me, I can't spend what has already been taken out ahead of time. Next slide, please. So in 2019, I met with leadership at Lake Region Electric Cooperative in Minnesota. For years, they had recognized that many of their employees were struggling to save for life's unexpected needs. They felt that financial fragility was contributing to employee stress and a loss of work productivity. The question for them was, would our employees be better savers if they had that extra push? It was through brainstorming and understanding of Homestead Fund's products and services and recognizing employees' lack of financial preparedness that Lake Region leadership felt they could be part of the solution. The solution was the foundation of the employer-sponsored savings plan program that is done at Homestead Funds. They proposed to their employees that through the use of Homestead Fund's mutual fund accounts that were aligned with employee goals and balancing objectives for safety and principal growth, that they could give their employees an opportunity to grow assets at rates of returns provided by mutual funds, while also having access to their money when they are in case of a financial hardship, either now or in the future. The added bonus would be that with that extra push, the cooperative could match savings dollar for dollar up to a certain amount. Next slide, please. Through the employer-sponsored savings plan program, the cooperative can be part of the solution by helping its employees be financially prepared. The importance of being the solution is beneficial for a few reasons. The first one is that employees are more motivated to save if they have that incentive. We've seen the scenario with 401k accounts as employees are motivated to save if their employers are matching their contributions. We can see the same thing if employees feel the same way about savings just for a rainy day. The second point is that the commitment level for the cooperative can be as large as small as possible. And it's really up to the cooperative to determine how much they want to supplement in that situation. Number three is that Homestead Funds can help assist in this program setup for the cooperative. So you're not doing this alone. And then finally, the end result is that employees can build savings over time while having access to it when it's needed. And that's really the goal of the savings, is to put money away and then when it's needed to be able to have access to it. Next slide, please. So establishing an employer-sponsored savings plan takes coordination from the cooperative, Homestead Funds, and the employee. For the cooperative, the most important actions are just really setting up the match limits and setting up the program rules. The next important action would be to be committed to making matching contributions. And then finally, the last step and the most important step for the cooperative is really to determine the holding period to earn the match. So hang in there. We'll go into a little bit more detail about this in a second. Now, when we look at Homestead Funds, how does Homestead Funds contribute to establishing this type of program? Homestead Funds is willing and able to assist in setting up an ESSP, or an employer-sponsored savings plan. Homestead can help by establishing an individual or joint taxable account for each employee. By establishing this type of an account, it allows the employee to own the account, have access to the assets at any time, and also establish an account that does not have employer control. The second thing Homestead Funds can help with is offering investment support by providing account opening assistance, investment education, and asset allocation guidance based on specific goals and risk tolerance. And then for the employee, it's just simple. It's just the employee setting up the account and making the periodic contributions. And of course, understanding that Homestead Funds is available to help implement a diversified investment allocation portfolio that meets the needs of the person's risk tolerance and of course their time frame for whatever future event that they're saving for. Next slide. It can't be stressed enough that the cooperative can customize an employer-sponsored savings plan to suit the needs when it comes to matching employer contributions. So let's look at a couple examples. Example number one, Cooperative A. Cooperative A has decided that if an employee contributes $20 per pay period and makes no redemptions for a quarter, then the cooperative will add $50 to the individual's account per quarter as a reward for doing that. So if you look at it, and if an employee does that for the entire year and the cooperative meets that $50 match per quarter, you're looking at about a $720 contribution into an employee account. And that's not even factoring in investment performance. And as you thought back a couple slides, this is well above the $400 to $500 financial fragility problem that 36% of Americans are facing. Now let's look at Cooperative B. Maybe they decide that if an employee contributes $10 a pay period and makes no redemptions during the year, then the cooperative will do a one-time $300 annual contribution on a specific date of their choosing. This would equal to roughly about $560 in annual contributions, and again, without factoring in investment performance. Again, above the $400 to $500 financial fragility problem. The last scenario is Cooperative C. Cooperative C really wanted to stress the importance of keeping money in the account unless somebody really needed it. So individuals that can help grow their account get rewarded a little bit more. So Cooperative C, they decided, just like Cooperative B, if an employee contributes $10 per pay period, the cooperative will then look at to see how much money that the employee is using in their account during an annual basis. And if that employee doesn't take any money from their account during the year, then maybe they will go to a full $300 match, just like Cooperative B chose. But what if the employee takes out a certain percent of their account during the year, and we'll say maybe 10%? Then the cooperative may set up the program to say that they will get a $200 one-time annual match from the cooperative. And what if the employee takes out a little bit more during the year, maybe 20% of that account? Then the cooperative may say, since you're taking out a little bit more, we're only going to be committed to make a $100 match for the year. So again, the goal is to grow the account and to provide rewards for that growth. But also, if money is needed, there is a way not to penalize the employee at the same time. It should be noted that if the employee gives permission, Homestead Funds can provide the cooperative with verification of balance and account activities anytime during the year. But again, we need the permission from the employees, and we'll get into that in just a second. Next slide, please. Again, the cooperative can customize the program terms to suit their needs. The cooperative can determine program matching, like we just discussed in the last slide. It can determine if contributions are invested into a single fund, maybe like our daily income fund, which is an equivalent to a money market fund, or maybe to mirror a diversified portfolio if the employee is investing in multiple mutual funds within Homestead Funds for their saving needs. The cooperative has the ability to internally communicate the program and its terms to the employees. The cooperative really can decide, and with the input of the employee, if they would like to have access to account information, maybe like what Cooperative C did in the last slide. Again, we can provide the cooperative and the employee with a confidential agreement to be set up with Homestead Funds so that the cooperative does have access to employee accounts so they can monitor how the money is being used in those type of accounts. Again, the cooperative is there really just to set up employee payroll deductions to get this program going, and of course, meeting the match. Next slide, please. Again, as a cooperative, you don't have to set up this program alone. Homestead Funds is willing and capable of assisting with the process. At Homestead Funds, we can help set up a telephone or virtual call with each employee to help set up accounts and also to answer questions that employees may have so that you don't have to feel like you're the financial services provider. Two, we can provide education about our mutual funds, and we can do asset allocation assistance so that they can set up their accounts based on their risk tolerance and their time frame needs. And finally, Homestead Funds is there to provide the needed resources. We have an easy to navigate website, which they can get information and view their accounts. And of course, we have access to a deep bench of client service associates that are always ready to help. So as the slide says, we're happy for your leadership and your employees to lean on us to establish this program. So in final, going back to Lake Region Electric Cooperatives and Employee Sponsored Savings Plan, they implemented it back in 2019. And by doing that, their employees were ahead of the curve when we got to the 2020 pandemic. They were ahead of the curve for the current inflationary environment that we're experiencing right now. They had begun saving years ago in preparation for situations like this. As the end of Q3 of 2022, 74% of the cooperative employees at Lake Region Electric had established an investment account to become more financially prepared. So this program was that extra push to get them started. So at the end of the day, the cooperative provided a solution and the employees responded to that solution that the cooperative provided. So that wraps up really what I wanted to communicate with the employer-sponsored savings plans. It is a program that really encourages employees to start saving. At this time, I would like to introduce my colleague, Tamika Bishop. And Tamika will provide an overview of how cooperatives can provide financial preparedness options for the key personnel. Tamika?
Brian. I am here, one of two, well, currently three deferred compensations consultants, but one is handing that role off to another consultant. And so for me, I've worked between NRECA and Homestead funds for almost 11 years now. And I've had a fair amount of time with co-ops to be able to see and understand their needs for attracting and retaining top talent. So that's what we're going to talk about on today. Next slide, please. It's important that you understand why and how non-qualified deferred compensation plans are important. If you're an HR professional, you understand that there is a awareness that there are multiple factors in attracting and retaining talent. And there are even higher stakes when you're talking about key executives. So building a competitive and comprehensive employee benefit package is what we think is the most paramount among all other factors. Since COVID hit and labor markets have tightened, we've experienced an increase in cooperatives wanting more information about plans, plan options, and or desiring to establish one or multiple deferred compensation plans. And it's important to know that competition right now is fierce. In my slide, I said that co-ops are competing in a nationwide war for talent. And I know war sounds like a really strong statement, but believe it or not, we have seen cases where co-ops have attempted to recruit executives away from other co-ops. And that can be a pretty hard ball to play depending on what you have in place for those particular executives. Lately, there's been a lot of concern around our CEOs not wanting to lose their key staff to other cooperatives. And so we've been getting a lot of questions, especially when it relates to the tenure that they intend to stay at a cooperative. They want their staff to stay with them. So in the cases where we've seen deferred compensation plans in place, the cost of recruiting away was simply too high, and at least for that recruiting firm. And so in most cases, the costs didn't make financial sense for the recruiting cooperative. And they ended up going back and looking at other candidates. But that's what you want your non-qualified deferred compensation plan to do when you have one in place. So finding the right plan or defining the right plan and finding the benefits that are going to help you obtain the objective that your particular co-op has, that's something that we here will help you with. When we look at non-qualified deferred compensation plans and their flexibility, it's important that you have a differentiator in the game. So when we talk about the plan design, you can do a lot of different types of designs, from a contributory plan to a plan that's funded by a co-op. You can have vesting options, whether it's immediate vesting or using some future vesting date. And then here you can see co-ops can sponsor multiple plans at a time. And that's something that we do see as the competition continues to be fierce. Next slide. Who can participate? Well, we typically, when we talk to co-ops, we will have them take a look at their organizational chart, because we may say key employees, but that can be a different definition depending on who you're speaking of or who you're talking about. And so if you take a look at our sample here, a select group of management or highly compensated employee, you'll notice the highlights are around your top tier or top leadership roles. So if you look at vice presidents, your chiefs of staff, and then of course your CEOs, then they will all qualify for a non-qualified deferred compensation plan. From time to time, we get questions on other positions, whether or not they're eligible. And that's something that we can discuss on a case-by-case basis, but this is our general rule of thumb, wanting to make sure that you keep less than 10% of your staff within these plans. Next slide, please. With this IRS limitations on qualified plans, this brings more of a need where cooperatives will have to structure non-qualified deferred compensation plans to keep executives from losing out on benefits. So in 2023, you can see that there is a IRS salary or compensation limit that is $330,000 this year. Last year, it was 305,000. That's a pretty big jump from one year to another. So cooperatives are constantly trying to figure out where they are in terms of that threshold, where they need to start looking at their top management being eligible for these plans if they're not already. When you think about the retirement security plan that many of our cooperatives are in, or some other pension program, and when you look at the 401k plans that exist, any amount of compensation that is over that $330,000 limit will not qualify for benefits for that particular executive. So when you think of the loss that could, or the gap that's there in terms that will create a loss for your top level talent, then that's something that you want to consider. How can you bridge that gap? And these plans are what you can utilize to do that. There's also something called a IRS Section 415 limit. Some may or may not be aware of it, but it also places a maximum on the annuity portion that can be paid to a participant from the retirement security plan. So when you think of how a annuity benefit can be converted to a lump sums are capped at the present value of a restricted annuity benefit. Again, it's something that you want to take a look at, because if you aren't meeting the needs of those particular executives in such a tight and competitive work market, then that's going to be an easy way or easy target to be recruited away. So we want to make you aware of things to just take a look at on an annualized basis, and make sure that you're staying in touch and in tap with what the market is calling for. Next slide. Here you'll see that there are several product offerings that we have, everywhere from the Executive Benefit Restoration Plan, our 457B plans for executives and for directors. We have a Top Hat plan, which you can see, again, employees and directors, but this is for taxable entities, where the 457B plans are for tax exempt entities. And we wanted to also show you the performance incentive plans. We wanted to show you where we are currently as of March 1st of this year, the number of plans that we have in place, the number of participants within those plans. So we are definitely growing in terms of the interest and the establishment of the plans for our cooperatives. Currently, there are about 385 cooperatives that participate in our plans. So again, these are all plans that we utilize, or we help you to utilize, to bridge gaps. If it's a tax deferral issue that your executives want to minimize some taxable liability up front, you can do that with a few of these plans. If it's restoring benefits because of the loss due to IRS limitations, we have plans where you can utilize for that as well. And then we can utilize these plans for everything in between. So as you can see here, a lot of participation, a lot of interest, and we're looking forward to hearing more from our cooperatives that definitely have a need. Next slide, please. And lastly, we just want you to understand that we are listening to you. We're listening to our members, and many of you may know that as of January 1st of last year, the non-qualified deferred compensation unit transitioned from NRECA to homestead funds. And as we have been building on that consolidation, we have created a bundled approach to enhance the services and the support for our members to meet their needs and objectives. So some of those things that we're talking or referring to is from a plan design and implementation standpoint, plan administration. We're here to help your benefit administrators, your HR departments, to effectively administer those plans that are in place or that we hope to get in place. Also, we are educating your employees at the participant level on investment education. So that's a big deal, because you have all of these accounts and assets that are growing. And so you want to make sure your participants also have the ability to be educated to help them grow. And then lastly, we are excited because we're going to be launching here shortly, maybe within a month or so, a new benefit administrator portal. That's something that will help bridge the gap of some of the issues we may have been having over time with understanding who our benefit administrators are. It's going to give them a way to look at plans and participants all in one place. So we're excited about this soon release. And again, if you have anything that you would like, if you have a plan with us or are looking to establish a plan with us, we are always open to hearing your feedback. We're always wanting to know exactly what it is that you want and what you need so that we can serve that need. And I believe that's it for my presentation. Up next is going to be my colleague, Christopher Hodges. He's the Senior Client Relationship Advisor, and he's going to be touching on how we make it easy for our co-op employees.
Hey, thanks very much, Tamika. Very happy to be with you folks today. And again, Chris Hodges, a Senior Advisor at Homestead Funds. Also, I'm a certified financial planner, have been for 30 years and have been with the NRECA for 15 years. So I've seen some of the names on the list of attendees, and I know quite a few of you, so that's kind of nice. What is Homestead all about? Besides what Brian has talked about and Tamika's talked about, when it comes to investing, this is for your private money. You know, we all, or not all of us, the far majority of us have the NRECA 401k plan. You might have the NRECA RS pension plan, and those are fantastic vehicles for retirement, but those are vehicles where you invest at work. Where Homestead comes in is this is for private money. What if you had some of the goals that you can see here on the left? What if you're saving for rainy day savings, some kind of big ticket item? You're saving to purchase a home in the future. Education of the children, maybe. That's a goal for a lot of people. The golden years, certainly retirement, the most expensive thing that you're going to buy in your lifetime, believe it or not, it's your retirement. So that's very important. So that's where Homestead comes in, is that if you need an investment account for private money, Homestead might be right for you. Some of the different types of accounts that we have, an individual or joint taxable account. We have the traditional IRA, which is probably the most popular, the Roth IRA, if you're looking for tax-free income in retirement. We have a couple of different education savings accounts, the ESA, and also the Uniform Gift to Minors account. Not to go into that now, but we can certainly talk to you about those vehicles if you have an education goal. And then also we have trust accounts for you as well. Next slide, please. It's nice to know that we have low minimums. It's only $500 to set up a regular account, $200 for an IRA account, $0 if you're making scheduled automatic investments. And that's one thing that many co-ops do allow for payroll deduction to come right out of your paycheck and send it over to Homestead. You know, we have over 13,000 clients at Homestead Funds, and the far majority of those clients are from the co-ops, co-op employees. And so it appears that Homestead is right for them. Maybe Homestead is right for you in private money. Next slide. In terms of investments, we have a nice variety of investments. We have a money market. We have 3 different short-term bond funds if you're looking for income. And then we have a variety of stock mutual funds. Next slide. Something to keep in mind when investing, especially when you get to quasi-retirement or full retirement, it's critical, is if you do hire a local financial advisor, you are most likely going to charge additional advisory fees. So here's a good example. If you have $1 million to invest, let's say a combination of your 401k and your RS plan, $1 million to invest, and you work with an Edward Jones or a Raymond James, someone like that, the typical fee that they charge is about 1.25%. 1.25% on $1 million in 1 year is $12,500. That's about $1,000 a month right out of your pocket to hire them as your advisor. Homestead Funds, it's 0. We do not charge those fees. And over a 10-year time frame, same example, 1.25% on $1 million, that's $125,000 over 10 years right out of your pocket. So who's becoming wealthy here? Is it the advisor or is it yourself? At Homestead, we do not charge those advisory fees. So that's important to know. Next slide, please. Another great thing about Homestead is that, everybody's different. Some people are conservative, some people are moderate, some people are very aggressive. And what's great at Homestead is that we have a process, we have a tool, it's completely free of charge. But if you fill out a questionnaire and basically tell us how your risk profile, how aggressive or conservative you are, we can come back and give you a very specific recommendation on what Homestead mutual funds to invest in and how much to invest in each. So that's a wonderful service. I mean, a lot of people come to us and say, just tell me what to do. That's what we can do. It's a free service. We do it all the time. We'd be happy to help. Okay. Next slide, please. These are some of my great colleagues. These are the folks that you would talk to on the phone or email with, or even do a Zoom video or a Teams type of video. Really good point here. This is part of our value proposition, is that all of these folks, including myself, we work on salary. We don't work on commissions. We're not trying to sell you something. Our job is just to give you guidance and service. And I think that makes people feel really comfortable. So I think that's one of our value adds. Okay. Next slide, please. So we do have a fantastic website, homesteadfunds.com. On this website, you can find out more about our funds, performance records, what they're made of, what kind of companies are in those funds. You can open an account right online, and you can try to do it yourself, or you can call one of us and we can walk you through the steps. You can check your account balance on a daily basis. You can make transactions. You can send money to your account from your bank. You can send money from your account back to your bank. You can place trades between your funds. So it's a very robust type of website right there. Excellent. Next slide. So if you are looking to set up a time to meet with one of my colleagues or myself, this is on the website. You can choose what subject you'd like to talk to us about. Just select a day and a time and your name and your phone number. And when that time comes around, we'll give you a call and we'll answer any questions that you may have. So that's a real nice service. Again, that is on the Homestead Funds website. So the phone number to reach one of my colleagues or myself, 800-258-3030, option number 2, or just email us at invest@homesteadfunds.com. That's all I have for the part of the webinar. I look forward to talking to you, and thank you very much.
Thank you so much, team. I saw that a couple of questions came in. The first question is, can a bank opt out of paying FDIC premiums? If so, are account holders notified or their bank does not pay FDIC premiums? So that's really a banking question, but every bank in their charter, federally chartered banks, have to pay FDIC premiums and hold reserves on hand to cover those deposits, up to $250,000 per depositor. And if a bank stops paying or holding those reserves, I don't know who's going to notify you, but that is something that is a requirement to be a federally chartered bank. But it's something that banks are required to do. The next question, is there an administrative cost to manage these accounts? And if so, who pays for that? I'm assuming that question is for the employee-sponsored saving program type of accounts, and there is not an administrative fee that we would charge to help work with your benefits administrator, payroll person. It works through our transfer agent, and it's all done in the initial account setup, and it's no charge by us. Then there was one more question, and that one was, is there any kind of penalty in taking money out of the employee-sponsored savings program? Good question. It's how you design the plan. There isn't a penalty if somebody were to redeem. However, we have worked with co-ops that if an individual takes it out in a certain period of time, then the co-op would not have any forward match to that program going forward. So they want to encourage savings. So some say that it has to be the match program, not the individual's payroll deduction. And once an individual puts it through payroll deduction, it's instantaneously their assets. And once a cooperative puts in on a match program, and the match program is entirely up to the co-op. These programs are designed with your benefits team and management to meet the needs that you feel that will help your employees. So you may do a match quarterly, you may do a match annually, you may say that we want people to hold that money in the savings plan for a year, and we could help with the co-op in managing that. If any individual were to take it out sooner, there wouldn't be a penalty, but the program in one instance would no longer make future matches for that employee. hopefully that answers that question. But that's something that we would work with your cooperative in creating an ESSP, Employee Sponsored Savings Program, to meet your individual employee needs.
Mark, can I add one thing?
Yep.
Also, keep in mind that Homestead Funds provides no load mutual funds, so there is no transaction cost in addition to putting money in as far as employer contributions, or if the employee needs to take out money for a certain financial situation in the future. So not only is there's no administrative cost, but there is no cost to make transactions in and out of the account also. Just wanted to clarify that.
Thanks, Brian. So the last question we're going to have time for is, where can we get this presentation to share with our employees? So if you're registered, this will be available on the website with the actual voice in about a week or so, and we'll be sending that out to all of those that registered. So you will see this on the website in a week or so. It has to go through compliance first, and then we will post it along with the voice with the presentation, hopefully. So thank you, everyone. That's my phone number. That's my email. If you have any further questions, please give us a call. We're here to help, and we appreciate all your support, and have a great afternoon. Thank you.